Okay, great to see everyone, and I hope you're ready for hopefully a whistle-stop tour of what is fast becoming one of the top and most important topics in the industry. Cyber Cat, are we ready? So before we get into it, I'm going to just introduce the panel really briefly. So to my left is Scott Stransky, Director of Emerging Risks and Risk Modeling at AIR. To his left is Jeremy, Managing Director, Head of US Cyber at Guy Carpenter. To his left is Matt Prevost, US Product Manager for Chubb. And to his left is Anna Maria, who is the Head of Treaty Cyber Business at Munich Re. Got a lot to cover, so we'll get right into it. So my first question is, what happened on April the 18th, 1906? Very good. Didn't even need the cube. So yes, it was the San Francisco earthquake. And the headlines were pretty disastrous. There was a huge fire, that followed the earthquake, and San Francisco was basically leveled. At 5:13 a.m. on 18th of April 1906, 7.9 earthquake hit the downtown center of San Francisco. There's a fascinating book about it called The Crack on the Edge of the World by Simon Winchester, which I'd highly recommend. And I'll just read out a few snippets about that event and come back to why it's relevant in terms of a history lesson. But the claims from that event and the fire relating to the earthquake were over 100 times the amount of premiums that were collected in fire insurance that year. It wiped out profits for the preceding 47 years. There were some earthquake exclusions, but the language was not standard or not typical. 14 insurers went bust. And in an attempt to deal with the aftermath of the earthquake and the fire that was spreading through the city, the local fire brigades tried to create fire breaks. They did this in the only way they knew how: dynamite. They absolutely destroyed whole parts of the city using dynamite to try and create a fire break. And in a classic case of the law of unintended consequences, the fires caused by the dynamite caused more damage than the attempts to stop the fire spreading. And of course, each participating insurer used their own language, so there was no consistency among the clauses, and of course, there was all manner of issues. So that is kind of quite a sobering lesson of what happened just over 100 years ago. And I think that there are some very interesting parallels with where we are today. So the next incident I wanted to mention briefly, and I'm going to read a quote from a study about this event, and I'd love to hear any thoughts about what I might be talking about. Insurers estimated the size of future losses using experience data based only on what had happened in the past. Actuaries simply adjusted recent history to reflect current trends. However, this event helped to prove that past data is a poor gauge for future catastrophe exposure. Previous projections failed to recognize that science indicated unprecedented events were within the realm of reasonable possibility. It is, of course, Hurricane Andrew, 1992. It's not, but the language in that report, of course, it echoes heavily. It could be talking about WannaCry, could be talking about any of the recent events. Hurricane Andrew and insurance, the enduring impact of a historic storm, is the report. It's the Swiss Re Institute. And it's, again, if you're a history nerd and an insurance nerd, it's right in your sweet spot. So this report was written on the 20th anniversary of Hurricane Andrew. And if you look at the numbers, it's pretty staggering. They wildly underestimated the impact of the storm. A number of insurers went insolvent, and it really was the birth of the modeling industry as we know it. We've come quite a long way in the 25 plus years since then. So that's my sort of context. And where we are today, of course, is thinking about events that haven't happened, about paucity of data, about limited actuarial insight. I'm going to kick it to my friends on the panel to help unpack some of the issues relating to this. So let's start with the basics. Matt, I'm going to start with you. What is a CyberCat event, and how does it manifest?
Yeah, so we'll level set with a very defined slide, and then we'll kind of break it back into the simplicity of what we're really talking about. So, systemic event that impacts multiple policyholders. Obviously, that is what we would refer to as systemic or could potentially be systemic. And then from a severity perspective, it's a portfolio level impact or an impact on the portfolio that is not risk specific. So that can range, again, from a catastrophic situation anywhere on a significant up and down risk. So as an example, a large tower, again, 500 million of coverage in a $3.5 billion industry is significant, all the way to the sideways exposures when we look at from a modeling perspective. Just a couple things I've heard, and this panel, and Ollie kind of alluded to it, came out of last NetDiligence conference where publicly stated someone had mentioned that we're not ready as an industry for a cyber cat, right? So that's what insurance is all about, right? Being there for that systemic or catastrophic event, but also thinking about learning from the history here. So just some of the positives, right? So I'll talk things I've heard throughout the day, wrote down some comments. I think it's all relative, all kind of a fun topic. So as a broker, my responsibility to make sure language will actually respond regardless of the breach. So that's kind of an obvious statement. You know, why not think systemic? I would also add kind of the small business session. The small business owner basically said, I hear the same thing every year. So one thing that we have historically talked about as an industry is what if the cloud goes down, really? A real kind of conceptual topic that we really haven't dug into the impact of kind of how big and relevant kind of the reinsurance community is, the primary insurer community is, and most importantly, the broker knowledge of a systemic event. The other aspect in that business interruption session was really our decisions being made based on systemic or at least catastrophic and stability. And I think we're kind of at the point where when we're using the what if scenarios, or what if this happens, what if that happens, it's hard to really make that transparent and relatable. What we're starting to have, again, in 17, and we'll get into some of the details, we did have a number of events that could be considered to be systemic and could be considered to be catastrophic if you play that scenario out a little bit differently.
Thanks, Matt. So, Anna-Maria, anything that different from a reinsurer's perspective about how you would define a cyber cat event? I mean, you're looking at treaties every day in your day job.
Yeah, I would just add that the real difference is we do view it the same way. We are looking at systemic events, widespread events, but instead of looking at one single tower that could potentially be impacted, we're looking at portfolios across various insurers. And so it does take a little bit of a different perspective from the reinsurance side. We do look at it from an accumulation standpoint, and so there's a lot of work that goes into assessing the cat risk that way.
Great, excellent. So we're going to test this out. Audience poll: in a systemic event, what are the biggest challenges for the cyber insurance industry? Financial stability, claim adjuster exhaustion, modeling mistakes, coverage confusion. What systemic event? While they're doing that, Jeremy, you're dealing with primary carriers and reinsurers, and you're kind of the meat in the sandwich. Yeah. How do you see this perspective on cat issues?
Yeah, I think from the approach of how insurers and reinsurers are looking at this, I think it's evolving. As the coverage and the exposure is evolving, and it varies company to company, it varies insurer to reinsurer. I think as Matt and Anna-Maria noted, I think companies are looking at this from an accumulation perspective and an aggregation perspective. The reinsurers look at it as Facebook or any headline breach in the news. How many insurance companies am I supporting? What is my max limit? Are there any treaty restrictions that would limit my PML? That's the accumulation. And then insurance companies are also looking at, am I primary, am I excess? Do I have a ventilated policy? How much is my exposure? And, of those policies that might have had a breach, what industry class is it? Are there other companies that I've looked at or written that may have similar attributes that might be susceptible to a loss? From an aggregation perspective, as Matt touched upon, multiple insureds involved in the same event. There's certainly modeling efforts underway, and Ollie and Scott will be able to attest to some of the work that's been done. And I think from the perspective of how insurance and reinsurance companies are looking at the risk, certainly they're looking at limits deployed and what the potential is, from a downward perspective on if an event happens and does breach a large portion of the book. I think reinsurance is being purchased, third-party tools are being invested in, certainly RDS scenarios as far as the cloud, payment card processors, or operating systems, certainly effective. And I think now the probabilistic, stochastic methods that some of the models are looking at are helping in kind of looking at how bad something could be, how much it's going to cost, and what potential reinsurance solutions are out there. So I think there's not one size that fits all. I think individual companies at different sizes are looking at it differently, but I think it's certainly progressing pretty quickly in the last 12 months.
So Jeremy, just to pick up on that, for the uninitiated, when you talk about scenario development, why does that matter? And what's the difference between like the probabilistic models and deterministic models?
Yeah, I think it puts it into real life perspective. As Matt noted, the cloud is certainly something that everybody's mostly concerned about as far as from a systemic perspective. So, looking at and collecting data on, which cloud providers, are within a book. Is it 80% Amazon Web Services? If so, what does that mean that companies are going to do? Are they going to look at that more selectively? Are they going to start non-renewing? So I think looking at, disaster scenarios help, with the PML, but then looking at it from a probabilistic view and being able to actually attribute return periods to figure out, in the tail, what is the potential of this, and how am I going to make my reinsurance, solutions? How am I going to pick the best that's best for my company from a capital perspective?
Scott, I know you've been doing a lot of research on cyber catastrophes within the Verisk community. Tell us, has there actually been a cyber cat by your definition, and and how bad has it been?
So I think there's two different levels of cybercat. You have the Hurricane Andrew or the 1906 earthquake type events. We haven't seen the cyber version of that yet. I'm pretty sure most people here would agree with me on that. We have seen what we'd call a cat event, maybe the Hurricane Hugo of cyber. And I think NotPetya was a very good example of that. With NotPetya, we estimate the losses were around $3 billion in total, which is a pretty decent-sized event. It's in the realm of a small hurricane. It's in the realm of a tornado outbreak or things. This, though, is not on the scale of a Hurricane Katrina or a 9/11, to bring up those examples. However, even with NotPetya, most of the loss was not from affirmative cyber policies. And I know on the slide, which we are not looking at right now, it asked, well, so where does silent cyber fit in? And with NotPetya, we saw much of the loss was actually from property policies. It was business interruption loss from folks who didn't have a cyber policy, but they were able to collect that business interruption loss from a property policy that they did have. And silent cyber actually is where we see the potential for a very large aggregation event. I know the cloud, that's a classic example. We've done a lot of studies on the cloud. And indeed, from an affirmative perspective, that's a great area for seeing a large aggregation event. But when we get into the silent cyber realm, there's a lot more things at risk, a lot of property risk, a lot of very large scenarios we can envision. I know I always bring up my favorite TV show, CSI Cyber, so I'll bring it up here as well. Has anybody here seen the episodes of that show?
Oh, one in the back. There we are. Well done.
They really, really didn't want to admit it. It was canceled because I was apparently the only one who ever watched it. Either way, there's 33 episodes there. Those are all excellent aggregation events. And indeed, I forced my team to watch it. And we're studying those episodes to really learn about aggregation. I'm not going to give the example I've given in the past. Actually, one of the key silent cyber aggregations in this show is actually for auto risk. Auto risk today is done very actuarially. Accidents happen in an uncorrelated fashion, so you can really use the law of large numbers to help understand auto insurance until cyber comes into the picture. Now imagine somebody standing on the overpass of the freeway with a Wi-Fi transmitter pointed down at the highway. And the Wi-Fi transmitter is transmitting some sort of malware to all the cars that pass under it. Many cars today are Wi-Fi enabled. So now this car, as you drive under the underpass, picks up a virus. And at 3 p.m. on Friday, anybody who has this virus, the brakes stop working. It's pretty scary. And it would lead to a large aggregation risk for auto. A lot of people are writing auto risk. They're not really considering the cyber aspect. So that's one example of where all these lines that are being written today could lead to a major cyber cat event, just given how technology has evolved.
That's fascinating, and I think auto is just one example of some of the types of catastrophes that what at one point may have seemed fanciful is now very much in the realm of plausibility. In terms of the reinsurance industry, there's a somewhat confused Homer Simpson. It's the best image that I could come up with. In terms of the reinsurance industry for systemic risk today, so Jeremy, you talked about some of the tools. Now, what does that mean in terms of translating that into live action? When you're actually transacting a deal, how does that then manifest in the actual negotiations and the policies themselves that come out the back of it? And then I'll pass it to Anna Maria after you.
Yeah, sure. So, I mean, from the perspective of putting together, an underwriting submission that really shines the insurance company in the best light, I think, putting together, profiles is easy, but, identifying who the underwriters are, what the interaction is with underwriting claims, ERM, looking at the book from a primary excess perspective. Is the book global? Is it U.S.? Is it focused on primary? Is it focused on excess? What are the policy forms that the company is utilizing? Have there been any recent revisions to them? Are broker forms being used? Really understanding what the business is and being able to explain that to the reinsurance company. Looking at underwriting guidelines that companies might have, underwriting authority. Who has the ability to, put out a $25 million policy versus who has the ability to put out only a $5 million or a $10 million policy. Does the company look at industry class and limit how much limit deployed, by industry? What type of investment is the company making in third-party tools, whether that from a risk perspective or an aggregation perspective? Then really looking at, what the loss experience has been. Is it affirmative coverage only? Is there some non-affirmative coverage that might be coming in that we're looking at? And then how do you actually quantify that? So that's been something that we've been looking at over the past 6 months, I would say. But really putting a package together to differentiate that company versus the next, and then figuring out what type of solution is available. And there's many solutions available in the marketplace now, as Anna Maria writes on a daily basis. But, from the perspective of how companies are buying reinsurance, there are a lot of move towards standalone reinsurance from a cyber perspective. There's still a lot of treaties that are placed within professional lines treaties, so E&O, D&O, and cyber being a component. But I think looking at these on a bespoke basis and looking at the company in the best light and putting that forth, and then getting the market. And the marketplace is expanding from the reinsurance perspective. If the alternative capital is, I would say, lagging a bit, just from the perspective of looking at how this is modeled and the tail of some of the business. However, there is a vast amount of reinsurance capacity available as people are realizing that this risk is not going away. And if they're not in it now, they're really looking to get into it and understand it.
So you can tell Jeremy's a polished broker. Anna Maria, can you translate that? What does that actually mean if you're sitting on the other side of the fence? How does that? Where's the center of gravity in the decision making? Is it in the underwriting? Is it in ERM? What does that actually translate to in terms of what kind of deals you might agree to or might not agree to?
Yeah, so I mean, I would agree with Jeremy on most of those points. That is really what we're seeing. We're seeing a lot of, traditionally, the risk had been reinsured within blended treaties, mostly professional liability. Now we are starting to see some more standalone business. Most of it is quota share, and that really plays into Munich Re's appetite. We do see some AgStop, XOL type structures in the market as well. But really, I think what we look for is that our clients have a global strategy, that there is a unified approach to underwriting the business, and not just from a rate perspective, but just in terms of coverage and authority and limits management and all of that. So we do take all of those pieces into consideration. I wouldn't say authority to write any or appetite to write any one client sits in any one sector of the reinsurance space, but we definitely have a lot of actuarial support. That was one of the things I learned very quickly at Munich Re was actuaries play a very large role in this business. And so it is.
Some might say they run it, but
But it is a collaborative effort, and it is all about getting comfortable with policy forms, especially coverage expansions, as we're seeing now in cyber. We do see, the coverage has evolved so quickly over the last few years, and it's evolved not just in terms of scope of what it covers, but in terms of limits and how much we're offering, and what may have been sublimited a year ago is now full limits, and that type of conversation we have with our clients regularly.
sorry, Matt, go ahead.
Yeah, just to hit NotPetya, again, right? So you have Homer Simpson, obviously he works in a nuclear facility. He probably doesn't know any of those buttons that exist. I think NotPetya really, again, showed the industry that the focus on geography matters, so that's actually relatable to lines outside of just cyber insurance. And then also, we're talking about a single deployed tax accounting software in one jurisdiction in the world that really, as a room and as an industry, we weren't focused on. I think that was, in some ways, obviously it was not catastrophic to the industry, but I think that's almost like level setting and making sure we start to learn and apply what we've learned of knowing what Homer Simpson buttons, what those buttons are actually doing, and figuring out, not so much plugging the holes, but figuring out exactly where those questions are going to come from. Again, WannaCry is often referenced in the media, right? And that really was incidental. That was 200,000 computers versus NotPetya, which impacted, obviously, I think Scott's tally is about 3.3 billion. That's significant. And again, that's tax accounting software specific to a Ukrainian domiciled risk, which is really relevant to the conversation when we start to talk US-based software. And it's a question that no one asked, right? You ask anyone in the industry, myself, every reinsurer, everyone focused on what are they underwriting to, and this goes for the cybersecurity community too. No one was focused on that, and I think that's what we have to, as an industry, start to learn and share from, where when these systemic, and I use the word systemic, we could talk accumulation, we could talk catastrophe, but really when these things happen, what are we learning? And the first time I heard Ali's comment on kind of a significant majority of losses associated with the quake was actually the insurance industry making it, or I shouldn't say insurance industry, the fire brigades making things worse by using dynamite that actually just led to more losses. I think that's something that we've got to just kind of accept is NotPetya in its existence, despite it being 3.3 billion, that's kind of one of those scenarios where we can use as an industry and do use to make sure that that modeling assumption kind of fits.
There are some traditional tools that every ERM manager will tell you. You need to have a limits management and you need to have a diversification strategy. Is that sufficient today? I'll ask the carriers first, and then Scott, no doubt, it looks like you'll have to pick up on that.
Sure. I mean, I would just say that it's there are a number of tools out there in the market today. I do think that adds to the conversation. Going back to what I was saying earlier, I think there has to be this global approach to writing this business. And what we are seeing a number of carriers doing is they're restructuring their underwriting rules, their cyber practices, to get a better view of the entire business, the entire portfolio, not just cyber related, but property, casualty, all lines of business, to make sure that it's addressed on an overall basis, not just specific to cyber. We do need to look at all lines of business. I mean, right to the auto example, we need to look at all of the business. We need to have a common approach to writing the business, whether it's affirmative grants or affirmative exclusions. That needs to be done on a global basis across all product lines.
Great, no, I would agree. And in fact, Justine, would you mind putting the poll back up? Because I think that it resonates with the comments that financial stability, I meant to pick up on this earlier, that financial stability is really the driver in this audience in terms of the impact. And I think that's absolutely echoed here. Scott?
Yeah, I mean, speaking to a lot of the carriers out there, there's a whole spectrum of what's being done today. Some of the maybe less sophisticated carriers, or the carriers who don't have the resources to do things, they'll add up their limits, and that's how they manage the systemic risk. Frankly, that's not really a good thing to do, although it is pretty conservative. If you add up your limits, that's your highest end of loss, so I suppose that's okay. Some of the more astute carriers out there will use models. They may even have more than one modeled view of risk. And they'll start to run scenarios, deterministic events, against their book of business. So this could be a cloud event. It could be an auto scenario. It could be really a lot of different types of things. There's a whole range of different scenarios out there. But really, the next generation is in the probabilistic side. So where a scenario is like a what-if event, what if this happens, what does it do to my book? Probabilistic says, how likely is that to happen? So how likely is a cloud to fail? Is this something we really need to worry about? If I'm a carrier, should I buy reinsurance for that? Really understanding the likelihood and severity of the event, as opposed to just, if it happens, here's what the loss is. And that gives them the whole really spectrum of views, all the way from just adding up limits to fully probabilistic modeling to study what the risk could be.
And I think the point is that you can spend your life as a head of enterprise risk management at an insurance company worrying about asteroids hitting the planet or sun flares or these extremely unlikely events, but you know how bad it would be because you can add up your limits. Or you can use your capital and deploy it more efficiently based on what you think is modeled outputs. And I think that's where you're getting to, Scott. Matt, you had a comment?
Yeah, no, I think it's using this, right? So we have modeling mistakes. I think that goes across all lines. So there's themes that we learn, obviously, as the insurance industry, that modeling mistakes can be done, obviously, at a primary insurer level, a reinsurer level, an ILS perspective, that really are kind of those assumed, what is the 1 in 100, 1 in 1,000, 1 in 150,000, that really in the cyber context, that's the challenge right now, where the severity, we've seen kind of inklings of it. Again, 3.3 billion is likely the largest on record for the affirmative cyber or non-affirmative. I think really where we focus as an industry is more in the realm of, okay, what is that? And then what is the 1 in 100? And if that changes with tax accounting software in the Ukraine happening again, how does the industry react and interact and make sure that everyone's clear on what that exactly is?
And I would also respond to modeling mistakes being up there tied for second place. It reminds me of something we were discussing in preparation for the panel, and that's George Box, a famous statistician from University of Wisconsin. He always said, all models are wrong, but some are useful. And I think that's very important to keep in mind, that we build models, Ali builds models, our competitors in the audience, we all build models. Even insurance carriers are building models. There's lots of models out there. Nobody's going to have the right model. People have been modeling hurricanes and things for many years. There's still ways to go there. Cyber is much newer, but these models are useful. Getting many different views of the risk, understanding the potential outcomes, there's definitely a use for that. It's a tool. I wouldn't say to rely upon models completely, but I'd say models are definitely required to be used when you're looking at the risk.
At the same time, claim adjuster exhaustion, obviously 2% of the crowd are claim adjusters. Because I do think that's an element where when we as an industry, again, we use common providers, there's only 2 service providers in the room, right? So that's a post-incident basis. When this happens, if this happens, how this happens.
It sounds like a systemic risk.
On a systemic basis, how do we adjust and adapt and plan for that? And we'll touch on kind of the regulatory perspective on this, but it's starting to become more and more topical, at least in the US, from a regulatory standpoint.
So if I could just go back to the slides. I wanted to show this next slide because this is kind of interesting because this, so the Monte Carlo conference, if you haven't been, it's where all of our bosses go and sit and have cocktails on big boats. And they chew the fat and they pontificate on all the big issues of the day in the reinsurance world. And so there are some views from Monte Carlo that are very current. And what's interesting is that they run the entire spectrum. And most of these people don't actually know much about all the people in this room know. So it's kind of interesting to see how these perspectives vary. So I won't read all these quotes, but Andrew Newman, who's the head of casualty at Willis Re London, has got a real concern about accumulation risk. Victor Pignet is the CEO of SCORE, extremely cautious. Major appetite, Charles Goldie, partner Re. And this is probably my favorite. If we shy away from the challenges, we risk that the insurance industry becomes irrelevant. And I think that is a test to everyone in this room, and to pick up on what Jeremy said this morning in his opening remarks, that really, if this is a concern of a CUO at a leading cyber insurance reinsurer, then that should be a wake-up call to all of us that the irrelevancy is around the corner if we don't address these challenges. So, Jeremy, this is your world that you have to navigate all these egos.
Yeah.
What's your take on this spectrum of opinion about
Yeah,
the
I
crossroads we're at?
Yeah, I mean, it's interesting looking at these, these 4 quotes, and I think it is, indicative of, what's going on in our industry. We have a 20-year product that's evolved from a third party to now this, hybrid of first party and third party. And each company, the $3.5 billion of gross written premium, I've heard figures from 2.5 to 3.5. It's probably somewhere in the middle, depending on, how you're defining cyber and some of the tech, and media pieces. But you have insurance companies that are just getting into this business that are writing $5, $6, $7, $10 million. They're not as concerned probably in investing in a stochastic model. They're more concerned about not getting on that $5 million or $10 million policy that's going to have a loss. These are year policies, and I think we're looking at data. So how can you get data? How can you in the best way take in a submission and then also supplement that with any risk tools? So I think you have the large companies that are writing $300-400 million of premium, and they can take a couple losses. They might welcome it to see if maybe some of their competitors might be bumped out. But I think from the perspective of the major writers, they're trying to figure out in that Armageddon situation, how am I going to protect my balance sheet? And I think the tools are helping. As Scott said, it's not the be all end all of how companies are looking at protecting themselves, but I think it's just another tool in the tool shed.
Very good. And I think the takeaway for me is that it's somewhat inevitable that you're going to have a wide spectrum of views. I mean, today we are, you've got varying levels of maturity, varying levels of scale, and I think that it's fantastic to see that people are waking up to this issue. And to Scott's comment, I would agree that the modelling challenge is high, but also I think we've made collectively huge strides in just a few short years, whereas and not to knock our Nat Cat modelling friends in the room, but our Nat Cat modelling has been around 25 years plus, and they still get it wrong, sometimes, I'm told. Looking at how CyberCat compares to other types of event, I've put up a few images here of obviously floods and hurricanes, and being in California, I can't escape earthquakes as a topic. And so how bad is CyberCat in terms of the potential compared to some of these other major balance sheet risks? And I'll start with Scott on that.
Yeah, so I mean, you could look at, say, the average annual loss. What is the loss to the insurance industry from something like hurricanes or severe thunderstorms? And each of those perils are in double-digit billions of dollars of average annual loss per year. Cyber, we're not there yet, luckily, because premiums aren't even close to that. So if our average annual losses were double-digit billions, you all would not be in your jobs anymore. But basically what we see is that on the hurricane side, if it's, say, $10-12 billion per year, cyber's maybe 1/10 of that, just from the affirmative cyber perspective. Of course, it can grow, and as more cyber premiums are offered, as the take-up rates increase, we will certainly start to see that grow. That doesn't mean, though, that the tail risk isn't there. So while we talk about the average annual loss, which is what you expect to lose each year, say your 1 in 100 or 1 in 250-year losses can be much, much more extreme. For a hurricane, we're talking maybe hundreds of billions of dollars. For cyber, we're also talking hundreds of billions of dollars. And that should be a little bit scary, that a large cyber attack, a systemic cyber event, is on the order of a large hurricane event. Given that the premiums for cyber are so much less than they are for hurricanes, it goes back to Ali's original point, where that earthquake wiped out 47 years of profits. The same thing absolutely could happen for cyber. And we need to be proactive about this. We need to really understand this risk before it happens, unlike what happened with earthquakes or with Hurricane Andrew. When Hurricane Andrew hit and 11 companies went out of business, they weren't proactively prepared. Today, or even in 2011, let's say, we had the Tohoku earthquake, we had large tornadoes in the US and other events. There was only one insolvency around the entire world. We're not going to say it's completely because people were using models, but they were much more prepared than they had been back in 1992, certainly back in 1906. That hasn't happened for cyber yet. Really understanding the average annual loss is one thing. It's relatively low for cyber, but getting into that tail view, what is the potential plausible event that really can break the bank? I don't think we're there yet. We have models that are capable of looking at it, but I don't think the insurance industry has really gotten to the point where they're understanding those things and where really they're interpreting.
All right, Chicken Little. No, I think that's a really valid point, that the challenge with where we are today in the evolution of our market is that we don't know what extreme looks like. I think that's the short answer in my view. Matt?
Yeah, I think there's an element of modeled, non-modeled risks, right? So that's one thing, is this something that, again, you as an underwriter anticipated? And is this an event that is or isn't modeled? I think as the modeling tools, and I'll separate a little bit of the awkwardness between CyberQ and AIR, is that there is an element of, the more informed these models are, obviously the better that our industry does, right? So even just recognizing that when these tools started, and again, I'm gonna say that industry specific to cyber modeling is at most 3 years old, could be 4, where these tools that we are getting access to and starting to use and inform the day-to-day underwriting process and strategies is starting to be it's going the right direction. I think really where we struggle is that likelihood of the severity event. That's really an area that, and again, I'm going to say a lot of the industry struggles with, is what is the likelihood of the event.
So just to pick up on that, Anna Maria, what does that mean in day-to-day life? I mean, what does a cat load look like? How do you think about these types of extreme events and then translate it into looking at a treaty? And do you price for it? How do you price for it?
So, I would say that to start, we talk a lot about the opportunity here, the growing cyber market. It's $3 billion or whatever it is today, and then it could potentially grow to 2 to 3 times that over the next 5 to 10 years. And so there's the opportunity. But where we see it, the opportunity is really that we have to be in this market, we have to be in it in a responsible way, and we have to make sure that we're understanding the events that are happening and what the future of these events look like. So, we really have to look at it from an insurability standpoint. And, the 1906 earthquake wiped out 46 years of profits. Cyber doesn't have 46 years, right? We have 20, 25, and how much of that was profit. But so we have to be responsible. We have to study these scenarios, and we have to look at it in a very different way than hurricane and earthquake has been viewed, because those are natural events. Cyber events are man-made events. So they are very different. Technology is evolving at a much more rapid pace than climate change. So, we do see that the types of events are evolving, the way that we respond to them has to evolve, the coverage has to evolve, and so we are taking a number of different views of how we study.
I'm going to press you to be a little bit more specific here. In terms of language, are there exclusions or affirmative grants of coverage that can help manage that exposure better?
So what Munich Re does is we use scenario-based PML tools, right? And so we budget for worst-case scenario. And so we have our, there's cloud outage and widespread virus and data breach scenarios. But where we still have work to do and the industry has more work to do is on this non-affirmative side of the business. It's on the outage of critical infrastructure and then there war, terror, and all of these other new areas where we could potentially see catastrophic systemic events happening. So we do have more work to do on that side of the coverage, but we have seen some cloud language in the policy wordings that is pretty developed and
Jeremy, with your polished broker hat on, what do you do when you see these kinds of variants in language and exclusions and very justifiable position when it comes to trying to manage cat exposure?
Yeah, I think it's the biggest job of a reinsurance broker is to make sure that the language in the contract allows the company to operate their business, and there's no gaps between what the original policy wording says and what the reinsurance contract. Because the last thing a reinsurer or an insurer wants is to buy a reinsurance treaty that's not going to protect them. Understanding the exponential exposure that the reinsurers have and concerns over external network, I think the reinsurance treaties that are currently in place are on this quota share pro rata basis, meaning that you share in the premium, you share in the loss. The reinsurers need to understand that they are partners with the insurance companies. So, our job is really to make sure that, when there is wording that could potentially cause conflict between the insurance company wording and the treaty, that we'll make sure we understand it, that the wording, it makes sense. There's so much variability in the wordings as far as, how companies are defining system, how companies are defining computer, how companies are, defining data. So the reinsurance contract needs to really will be in lock and step with what, the individual insurance company is putting out.
Fantastic. Well, we've got one more topic that I want to touch on. If you have any questions, do feel free to shout out as we're coming to the last few minutes of the panel. So, regulators. Matt, you spent a lot of time in DC. Where do they, for good reasons, by the way, not. Where do you see the regulators fitting in, and why do they care about CyberCat?
Yeah, I'd say on a global basis, the questions around, the industry on systemic plan and almost systemic planning from a U.S. basis is the topic of mind, not just from a congressional perspective, but also Treasury, DHS, and a variety of different sources. So the questions, again, even if it's part of the regulatory process associated with all of us as insurers, that's already started, right? So the NAIC data supplement, they're now capturing data from 700 plus insurers who self-proclaim to be cyber insurers. So that's a big number. That's the
Only 700?
700. So, and that was the first that I had heard such a large number. I think the estimates previously were 170, which is also a big number. But the NAIC perspective and the data supplement is to make sure that this is controlled. And then also just from I'll say from a regulatory authority standpoint, is when this event happens, I think various parts of the government are really focused on making sure that we as an industry are prepared. And to the point of almost questions specific to this for preparedness, which again is the basis of why we should be talking about this more, is I think what we really are focused on is making sure that we're prepared for that event on a post-event basis versus just from a modeling and preparedness perspective and a financial stability part. So I do think it's, again, I think there's two post-incident service providers in the room. I know that's not a big number, but as we look at the industry, there's common providers on a post-incident basis. Again, I'll say congressional staff are focused on that kind of almost stranglehold on the post-incident forensics basis that would exist in a systemic situation.
And Scott, you've done a lot of research, particularly in London, I understand. You want to tell us a bit more about your work with Lloyd's?
Yeah, so Lloyd's is really keen on having people run scenarios against their books of business. And in fact, we developed a scenario with Lloyd's, or for Lloyd's, if you will. And I believe it's in the app. You can also get it from www.lloyds.com/cloud. But it's a cloud scenario. We feel that that's one of the biggest sources of aggregation on the affirmative cyber side. And Lloyd's also feels the same way. And what we did with Lloyd's was really build a study that looked at the economic and also the insured potential losses from a major cloud outage on the economy, but also on the insurance industry. And they're keen on doing this in many different types of scenarios. They have a data theft scenario, they have blackout scenarios, they have various types of scenarios that they force, in quotes, all of the syndicates of Lloyd's to run every 3 to 6 months. And this is something that they've done on natural disasters for many years, and now they've started to do this on the cyber side. But it goes beyond Lloyd's in the UK. As you saw on the slide, the PRA, the Prudential Regulation Authority, has also become very involved in the cyber world. And one of the things that they're having the companies do is really look at the silent cyber aggregation risk. And they're having companies really make scenarios against silent cyber as well as the affirmative cyber. By having this regulation, I think their goal is really to get people to think about this risk, as opposed to just sweeping it under the rug or kind of ignoring the risk. By forcing people to model these things or forcing them to actually think about them, at least it's on the top of mind. Just another note with the PRA, they're also having folks on the education side understanding cyber as a very important pinnacle of what they're doing. So the regulators are effectively telling the insurers, you better have people who understand cyber risk actually managing and running these books of business. And that's a pretty scary thing because a lot of these companies, there was
You mean the bottom 530 out of that list?
There was a spoof video that I've seen, it's on YouTube, where it's like a 6-year-old, and he's sitting there, he's like, I'm a cyber underwriter. I've been writing cyber risk for 6 weeks. And these are the types of people that maybe some of the...
Well, and I think, absolutely, I would agree that it's important to have the awkward conversation now instead of after a CAT event. And so the way that we see it, particularly when it comes to the PRA, they don't have the in-house expertise. They don't pretend to. But their role as a regulator is to force the conversation and have that discussion about capital adequacy, about expertise, about experience, and really try to push us as an industry to be thinking about the kind of maturity of our stability for this issue. So finally, we're coming up in the last few minutes. So in terms of progress, Anna Maria, how do you think reinsurers can improve the understanding of these types of issues from where we are today and say the next 12, 24 months?
So I think we've made a lot of progress over the last few years with the scenarios that we've developed. So we have a better understanding today than we did several years ago of cloud outage and data breach exposures and all of that. And so now I think where we go from today and where we are already is to continue to study the types of events that could cause systemic cat losses, and we continue to study them, and we continue to study silent cyber and outage of infrastructure, and we eventually will get to a point where we can assess it and underwrite to it and price it adequately.
So who rules the show? Is it underwriters or actuaries?
I'm going to say underwriters.
Okay.
Sorry, actually.
Matt?
Yeah, no, I think it's a combination of obviously the transaction itself, right? So understanding what this means at a policy count basis, that's underwriter, broker, service provider, and then also understanding kind of the risk transfer as you go all the way up the reinsurance marketplace. Again, the modeling and the importance of modeling, I think, is obvious to a lot in the product kind of role and in the reinsurance roles. I don't know if that resonates downstream, really outside an underwriter, but to a broker. I would also say just tabletops. Again, we stress tabletops as underwriters for companies to do tabletops. That's an area that the regulatory authorities will start to focus on to make sure that that thought process from an underwriter perspective is actually well thought out. So doing a insurer tabletop as if there were a systemic event, how you would respond to that is starting to become more topical and really a relevant conversation.
So Jeremy, brokers don't care about cybercat, do they?
Yeah, of course we do. Our clients care about it, so we do. No, I think the interesting thing about, or one of the many interesting things about this product in peril is that the profitability has been there. The loss ratios have been fantastic. However, I think how the industry is going to evolve, both from an insurance and reinsurance perspective, is to kind of figure out what is the probability of when it does go wrong. How bad is it going to be to my portfolio, or to the insurer portfolio or the reinsurer portfolio, and what is being done to protect that? And I think the tools are certainly helping. I think understanding what those tools are saying and what the input is that is going in that's creating the output will really differentiate. And then what are the decisions that are being made once you see that output?
Very good. And so, Scott, apart from self-interest, what do you see as the evolution of our industry in terms of how we can support the carriers and reinsurers?
I think it's just not becoming complacent. They have to look at plausible scenarios, tail scenarios, and understand really what could happen. And we're at a point in time where the modeling companies are able to produce probabilistic models. If we had this session a year ago or 2 years ago, we weren't there. But now the industry has evolved to look at tail events, 100-year events, 250-year events. And you all need to look at those things because, yeah, you're raking in profits today, but you get that 1906 earthquake and everything changes.
And maybe as a closing thought, when it comes to pricing, I know a lot of people on the carrier side have understandably been concerned about soft market conditions, glut of capacity, and so on and so forth. I guess the challenge I'll leave you with is, are we adequately pricing in cat exposures? And it's a bit of a rhetorical question, but I think that that's something that all of us as an industry need to think about rather than just simply focusing on the what happened last year. So are there any funny questions? We've got about 1 minute left.
So this could be for Scott or Anna Maria. You were talking about developing scenarios and cloud outage and data breach scenarios, and Scott, what you've done for Lloyd's. My question is, what's your confidence level on the outcomes of those models, and where's the data sourced from to help you produce those models?
It's a great question. I could spend 2 hours talking to you. We should meet offline. But yeah, we have a lot of different data sources. Briefly, we have information from carriers themselves. We have real cyber claims data that we've used to calibrate our model. We have actual incident data as well. And one of the key insights that we've learned from that is that if you just have insight data, say from publicly available insights, from news articles and things, you're going to miss out on a lot of the risk. You're going to way underestimate the risk, especially for the small and mid-sized businesses. That's one of the key sources, and that allows us to validate the model assumptions. Again, we should chat offline. I could go on and on for hours.
And in terms of the numbers, so to Rennie's point, the numbers that are coming out of there, I mean, there's a range in the research that you published, is that right?
Yeah, so we have confidence intervals. We're able to run our model with various different settings and see the sensitivity to those settings, build 95% confidence intervals.
And I would just add, from my perspective, I think one of the key aspects of having any model is having a transparency, so you understand the methodology behind it and not just the number that comes out of it. Any other questions? Yes?
Quick question. So obviously the events that you were talking about in 1906 and the Hurricane Andrew, there were companies that went out of business. Do you think there's potentially insurers today that could go out of business if a cybercat hit?
I'll offer a very brief thought. I think the short answer is no, but there's an absolute likelihood of cyber books being closed down as a direct consequence if mishandled. Matt,
I
Jeremy?
think it's the importance of diversification, stability. It's really what we should be as an industry.
All right, I think we're pretty much out of time. So with that, I'd like to thank the panelists and thanks for your attention. Appreciate it.